This is the first of 3 recordings on Chapter 4, so it's consolidation of a wholly owned subsidiary that's acquired at more than book value. So it has a differential. We're going to use equity method. So the parent's books is going to report the investment at what you paid for it, so it's going to be representing the fair market value of the net assets you acquired, or the investment in stock, plus the goodwill, or minus any bargain purchase price. The parent can use cost or equity method, it's up to them. The subsidiaries' books are reported at their book values, and their income statement has expenses reported based on their book values. So when we consolidate the parent and the sub books are going to be at book value. When you combine it with the parents, you basically need to write the assets up to fair market value to get to the consolidated numbers. So you need to make adjustments to the balance sheet, and you need to make adjustments to the income statement, because the depreciation or amortization of the subsidiary's assets will be different, because the fair market value is different than the book value. So the sub is recording its depreciation and amortization expense based on the book value, but the consolidated entity should be doing it based on the fair market value at the date of acquisition. So, big picture, you have assets that the value will be different on the consolidated entity. As a result, the following accounts are going to be impacted on the income statement. And basically, if the acquisition price is higher than the book value, all of these expenses are going to be too low, which means that if the expenses are understated, the income is going to be overstated or too high. So we need to increase expenses, which will decrease the income. So here's an example where Pepper's acquiring salt. They're paying $442,500, and here's the analysis of what they're getting. And I don't like the way they set this up, because this is not how we usually approach problems. Usually what we do is we start with the price paid, subtract the book value, which will give us the differential. And then I'm going to take the over or under valuation of the assets. So the inventory was overvalued, meaning what I'm doing is directly adjusting the differential to reflect how much of it is explained by these assets. So if the inventory was overvalued, I have to decrease the value of the inventory on the books. So I'm adding it back to the differential, because the differential actually is larger because the book value of the inventory was higher than it's worth, whereas the land was undervalued. So $39,000 of the differential is explained by the land. So there's $39,000 explained, so I'm subtracting it from the total. And all the rest of these were undervalued, so that explains part of the differential, and I end up with goodwill of $26,000. So this is usually how I set up the problems as we go into them. This is how the textbook shows it. I kind of don't like their format, because the way they talk about it, we do 2 tables. We do one table that it has the book value and explains that. And then we have another table that explains the differential, which is 195.5. And so that's what we're going to see when we set up the tables and do the eliminations. So based on 2009, the subsidiaries' activity, they have income reported of $78,000. They have dividends declared of $45,500. So based on that, what would be the income that the consolidated entity would have? Well, the cost of goods sold should be lower because the inventory was worth less money, so the expense should be less. The depreciation was worth more, or the equipment was worth more, so the depreciation should be higher. And the contract was worth more, so the amortization should be higher. So we should actually have an increase to expenses of $15,000. So we're going to have to adjust this net income down by $15,000 when we do the consolidation, which ends up with us having income from the subsidiary reported on the parent's books of $63,000, which is the 78 minus the 15. So how we do this, if we're doing equity method, we usually record the parent share of the sub's income, the parent share of the sub's dividends, and then we do an adjustment for the difference between the book value and the fair market value of the assets. So we'll do a third entry, which we call the amortization entry, where we do the adjustment to the income reported. So pretty much the same information we had before. So here's the reporting of the subsidiary's income on the parent's books. Here's the reporting of the dividend declared by the subsidiary. So we actually haven't received payment of this yet. This dividend receivable will be cleared off against a dividend payable account on the subsidiary's books. And here is the additional expenses. Notice we're debiting income from the sub and decreasing the investment account. So that's the $15,000 of additional expenses we needed because of the difference in fair market value. And if we look at the T account, you see the beginning balance. It increased by the net income, decreased by the dividend, and then we have this income adjustment in there, which brings us to our ending balance. And we call it amortization of the excess. Okay, so this is what I was sort of alluding to before. I mean, when they talk about it, they talk about the book value and the differential, so I don't understand why they don't just kind of use 800 and 700, but they always like to break it out into three numbers. So, okay. So when you have a subsidiary and we do the consolidation, in addition to the book value, eliminating the book value, we have to eliminate intercompany items. We also have to now update the sub's assets and liabilities to fair market value, because now we're no longer putting the restriction on that book value is equal to fair value, because that's incredibly unrealistic. We also have to recognize the goodwill. So we still have the same basic eliminating entry, and this is recording the book value. Okay, so that's always going to happen. And when we have a non-controlling interest added to this, we just are adding the two non-controlling interest accounts. The next one, we'll call this the reclassification entry. This is actually just dealing with the differential. So the other credit to the investment account for the amount we paid above book value. So part of it went to goodwill and the rest of it affected assets. And then we have the amortization, and so this is what changed in that differential balance during the year. So this is the additional depreciation or amortization expense, the additional cost of goods sold, or sometimes it's credits to things, okay? So that would be the amortization expense. And then accumulated depreciation adjustment entry. Okay. So here's that example we were looking at, a new one. So they paid $1.6 million in cash. They want us to divide it into the major elements. This company had goodwill, so notice when we acquire it, you don't bring any of that goodwill over. You assume it has zero value, and then you decide if there's goodwill after you put everything else at fair market value. So any goodwill that a company has when you acquire it, you assume it has no value. So when we go forward, we've got a $1.6 million cost. The book value of, or the owner's equity, is $980, so we have a differential of $620,000. So they're saying the inventory was undervalued, the notes receivable were overvalued, the land was undervalued, buildings and equipment were undervalued, patents were undervalued, goodwill was overvalued. You have to take it off the books because it was included in their book value. And long-term debt was overvalued. So that means that the debt was reported as being worth more owed than we needed to pay. Now what they did here is they added these up and then took the total and subtracted it as one number. Usually when I do these on the textbook, I don't do a separate column and a subtotal. I usually just subtract them directly. So if the inventory is understated, I would just subtract it from the differential. If the notes receivable are overvalued, I would add them back. The land is undervalued, I'd subtract the amount because it's explaining that much of the differential. It's explaining why did I pay that extra money. So the goodwill, I didn't pay that, so I have that much more I have to explain. The long-term debt was undervalued, I guess. Yeah, it was undervalued, meaning I have to pay $70,000 more, which explains the $70,000. And then I end up with goodwill. Okay, so what did we pay for? We paid $1.6 million, so part of it was for the book value, $980. Part of it was for the excess value of the identifiables, which was $280. Part of it was goodwill, which was $340. And again, that together is $620. And you'll see when we do our eliminating entries, we do $980 for the book value, and we do $620 for the differential, which is made up of the goodwill and the other excess or differences between fair market value and book value. So you'll see in this, some of these, you know, there's some credits here. We had the old goodwill and the new goodwill, and that's fine. Okay. So those basic elimination entries, I feel like I missed something here. Okay, I'm good here. So this looks like we went back to another exercise they gave us earlier. So we have a basic elimination, an excess value elimination. It looks like the same numbers we just worked with, and accumulated depreciation. The whole idea with the accumulated depreciation is we're taking that off because you wouldn't have any accumulated depreciation associated with a new asset. So we're taking that off and showing just the net amount, and then we're adding to that to get to the fair value. So this will be part of that differential eliminating entry, which is writing the fair market value up, writing it up to fair market value. All right, so here's an example of the worksheet, and we're going to go ahead, and this is what it would look like as you're getting ready to do these eliminating entries, and then we'll put them onto the worksheet. So our balance sheet setup, it's 247, and we got the common stock and the retained earnings. This is at the date of acquisition. So our amount we paid was $442,500. So our eliminating entry is common stock, retained earnings, and the investment account. So our elimination is for the book value. We had $195,500, which was equal to the differential, and that was overvalued inventory, undervalued land, undervalued equipment, undervalued non-compete covenant, and goodwill. And we put those into the eliminating entry. And when we record that into the T account, that would go towards the original investment. And when we look, that is now canceled out. And if we are doing the accumulated depreciation eliminating entry, it would be debit to accumulated depreciation and credit to B&E. When we put this all into the worksheet, this is what you get. So again, you will see it's just a balance sheet because it's date of acquisition. So you actually will see on a lot of these worksheets, they'll do book value and excess value, so they are actually combining the goodwill and the excess difference between fair market value and book. A lot of times I just rewrite do it and just put it into one number there. So that should be to 0, and we see that happening. We should see the common stock, APIC, and retained earnings resulting in just the parent's balance. Okay, that's good. What you're seeing happen here with the land is that they're actually writing up the subsidiary's land. They're increasing the value of it by $39,000. Here with the inventory, this is taking it down because we were saying it was overvalued. So you can see those transactions occurring.